It was a nice snapback day for Wall Street, especially for the Nasdaq, which closed up over 1% here today as speculators were a little bit more willing to take on risk again. Much of the enthusiasm was around the expectations of a rate cut at the end of this month, which rose all the way to 90%. It was at 46% prior to that. So a lot of folks are thinking that some of this economic news that we've seen come in a little bit below expectations recently will encourage the Fed to cut rates yet again. We did see all 11 sectors that were higher today, but with the 10-year Treasury yield falling all the way down to 1.53% today, real estate happened to be one of the better places to be hanging out today. So that is where our trade application example is going to come from in tonight's video. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's October 3rd, 2019. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go to our description area and sign up for our email distribution list if you haven't done so already. Those of you that are on our email distribution list might have received an email from David earlier this week regarding one of the specials that we're running for this week alone that will allow you to sign up for all 8 of our trading rooms at a very low rate. In addition to that, we're also heavy users of Twitter. Make sure you're following me. My handle is @BrandonVanZ. We also appreciate those of you that click like and retweet on these Market Outlook related posts. And lastly, we have a presence on Facebook as well. Make sure you're following us there at the group embedded in the logo in front of you. All right, let's go ahead and dive into the charts. As you can see, I've got chart 4B pulled up here in front of us. And as a reminder, this is just a 4 grid to look at the 4 major U.S. equity indices. S&P 500 was up about 0.8% today. Dow Jones was up 0.47%. NASDAQ Composite was the biggie. It was up 1.12% today. And then the Russell 2000 was up 0.45%. So the NASDAQ, as you can see, was a pretty healthy looking candle there. In fact, we closed at the dead highs of the day. And you can see that we engulfed that prior candle there as well. Whereas the patterns on the other 3 charts are a little bit different. Notice that the high of today is firmly below the high of yesterday in all 3 of these other charts as cases. So nice strong rally there, bounce for the NASDAQ Composite. We'll see where that takes us. As it stands right now, unfortunately, we still retain our bearish postures across the board despite the healthy rallies here today. In fact, this is a rare day where we closed at the highs on all of the major indices except for the Russell 2000, just barely didn't close at the high there. You'd have to kind of squint to see that there is a slight upper shadow on that candle right there. But you'll notice the rest of these candles, those things are basically telling you if the stock market were open another hour or two, we probably would have rallied even further. So at this point, we're heading into tomorrow's open with a healthy enthusiasm. However, remember that a bucket of cold water could be awaiting investors in the form of the jobs report that comes out every Friday of the first week of the new month. And that, of course, is tomorrow. So we'll see where that takes us. We also have earnings to be aware of. We did have Costco come out with their earnings earlier here after hours, so maybe half an hour or an hour ago or so. Last I checked, Costco was trading about in line with where it had closed for the day. But remember that as we start going into the next month, we'll start getting all of those S&P 500 companies coming through with their earnings announcements. That does have the potential to change the trajectory of the market as well. So we'll keep our eye on that and report accordingly here in these Market Outlook videos when we see anything of note there. Let's go ahead and now that we know that we still retain our bearish postures across the board, we can kind of take a look at the markets from a slightly different vantage point. In this case, let's go ahead and talk about our 3 green arrows. This is chart 4D. And as I mentioned on Tuesday, we had 3 red arrows at that time on all 4 of our charts. We continue to have 3 red arrows on all 4 of our charts. However, there is something new to report that is a healthier sign, which is the MACDs are starting to roll higher. Notice here that we have a kind of a color-coded system when we're looking at the MACD histogram. And generally, when those MACD bars continue to go lower and lower and lower, they're painted red. When they start winding back higher, they're started to paint gray. Over here, this would be a pretty good example of that process playing out, where these red bars continue to grow and grow and grow, telling us that we had more and more negative price momentum. And then when this gray bar started rolling higher here, you start to see that's when we start to see some more of these more positive and bullish candles starting to take hold there. So, whether that ends up being fool's gold or not this time around is anybody's guess, but at least it's a start where we have 3 out of our 4 charts. The only exception to that is the Dow Jones continued to put in another red bar here, but you can see the S&P 500 is gray. We had the NASDAQ composite gray and the Russell 2000 gray there. So maybe, just maybe, we're starting to form some of those bottoms here. And I think it is a healthy sign as well when we start seeing those long lower shadows on our candles there. Remember, that candle, we might very well look back a week or two from right now and say, yeah, that was a hammer. That was a very good sign that the bottom was being hammered out, and it was an interesting time to take some speculative long trades. Now, a lot of times those hammers do need to be confirmed by a higher candle the next day. So, at least we know that there is a catalyst, a potential catalyst tomorrow in the form of that jobs number. If we see a market rallying violently into tomorrow's close, that could actually be the signs of some sort of a bottom that's being put in place here, because a lot of these hammers, or at least potential hammers, are being formed at areas where you might make the claim that they're at support, right? This candle right here is at this support that shared a common horizontal support level with these candles over here and these candles right here and right here. So this is a pretty important place to be posting that particular potential hammer candle. All right, moving right along now to our slightly longer term view. This is our 1040 crossover method now. One thing to be aware of is that not only did we get long lower shadows on today's daily candle, like I showed you just a moment ago, but as we now transfer our attention here to these weekly candles, notice that we've got the same thing. We've got long lower shadows right there, right there, right there, and right there. Now again, it's only Thursday. We've still got one more day to see how this weekly candle plays out, but assuming the market behaves itself tomorrow, that will be another healthy sign going into kind of the weekend there, as investors will be thinking about where they want their money positioned. Now, as we're looking at this, you're probably noticing that one of these 4 charts does not look like the others, and that is the Russell 2000. As we've been stating for the last several weeks, the Russell 2000 does currently have a negative crossover when you're using the 10-week moving average and the 40-week moving average. So with that orange line down below the blue line, we generally view that as somewhat bearish, although this has been more choppy sideways than truly trend-changing bearish. Nonetheless, you just haven't had the positive momentum in the small cap Russell 2000 universe the way that you have in some of these more blue chip and large cap areas out there. All right, moving right along now, let's do some 12 grid analysis, starting with chart 5, actually 5A, the asset class 12 grid. All right, so as we're looking at this here, you can see that we have a healthy mix of various colors. As I was mentioning to you guys in previous sessions, we have 4 different color combinations. So we either have dark green, light green, dark pink, or light pink. And on this particular set of 12 grids, we have an example of all of those. So remember that the light pink are going to be considered weekly bearish charts, not in terms of time, but weak as opposed to the opposite of strong. So weekly bearish would be the light pink. The dark pink would be viewed as strongly bearish. Now, this is in accordance to the way that we read the intermediate line on the market forecast technical indicator, which you can find over on the Thinkorswim platform. When you're looking at the dark green shading in the background color there, that refers to strongly bullish posture. And when you're looking at the light green background color, that means it's weakly bullish. So, as you can see, we've got a mix of all of those. The 3 strongly bullish charts are the ones that you can kind of see here off to the left-hand side. You got your long-term U.S. Treasuries, as I mentioned to you in the intro. Interest rates fell a pretty healthy amount here today. You can see that in the lower right-hand corner there. That's your 10-year U.S. Treasury yield. It closed at 1.53% right now, which we're just a stone's throw away from the lows that we placed here kind of towards the end of August. Of course, when interest rates are going down, treasuries themselves or bonds are heading higher. So We had some stabilization, improvement upon the charts of long-term treasuries, and you could say the same thing here with foreign bonds as well. So those would be considered strongly bullish posture according to the market forecast. And then, as I mentioned to you on Tuesday, the US dollar has been just plowing higher. It's very strong. Now, we have had some sell-off days here in the last few, but that trend remains fully intact. There's no threat of that trend changing at this moment in time. So that's where we have our strongly bullish postures. In terms of the strongly bearish postures, unfortunately, one of them is the S&P 500. That's the chart in the upper left. We also have foreign stock market in terms of the foreign emerging, right? That's different than developed. So emerging would be things like China, India, etc. So EEM is struggling here. We do have high yield bonds struggling. Now remember, not all bonds are created equal. High yield bonds oftentimes act completely different than long-term U.S. Treasuries, which are deemed to be reasonably safe. High-yield bonds are, in other words, junk bonds. Junk bonds oftentimes belong to the riskiest corporate businesses out there. And so if there are struggles in the economy, those corporations are likely to struggle, and those that are investing in their bonds start to get a little bit more nervous that they're not going to be able to make interest payments, etc. So we have seen a sell-off in high-yield bonds here recently, although they were up just slightly today. However, their intermediate posture remains strongly bearish. Oil remains strongly bearish as well. We did have an oversold cluster signal yesterday from a daily chart perspective on oil, so maybe there's some hope that we can get some sort of a dead cat bounce here. But boy, oh boy, what a head fake that drone bombing over in Saudi Arabia a couple weeks ago has been. Oil prices shot higher on that day and have been doing nothing but giving all of that and then some back ever since then. So I'm sure there are quite a few people that ended up getting trapped in that particular move. Also, interest rates themselves would be considered to be in a strongly bearish market environment. Moving along now to the sectors. As I mentioned in the intro, from a sector perspective, all 11 of our sectors actually closed higher today. However, you will notice one standout down below from an intermediate term perspective, and that is the utility space. In fact, the utility space is the only green chart on the board, let alone whether it's a light green or a dark green. In this case, it happens to be a dark green color. So it's holding up reasonably well. Now remember, interest rates are falling. When interest rates are falling, all else being equal, you're going to find that utilities and typically real estate hold up better. Now, more recently, real estate has kind of pulled back a bit more than utilities have. But as you can see, those are the only two charts on the board that have a green moving average here currently. So I'm not talking about the background color of the chart now. I'm talking about the moving average. So even though real estate doesn't have the best posture right now, the fact that its price is above a rising moving average is telling you that at least price candles themselves are holding up reasonably well compared to the alternatives that are out there. You'll also note that real estate was up 1.19% today, second only to technology. I mentioned before that the NASDAQ did really well today. Of course, a lot of technology stocks in the NASDAQ. So technology was up 1.23% today. But in second place, somewhat surprisingly, on a risk-on type of a day like this, we actually saw real estate 1.19%. And again, a lot of that would largely be likely due to the fact that interest rates were falling there. We had a lot of conversation about interest rates and dividend yields and different things like that in my question and answer session here today. Remember, the question and answer session is something that those of you that are premium yearly members of Market Scholars have access to. Real quick, you can kind of get a sense of some of those things. The recording is posted, and here's some of the content that we covered. We had a conversation about TD Ameritrade's decision to go to a 0.00 commission strategy going forward to match Schwab, and then we later found out in the week that E-Trade did as well. So if you want to hear my thoughts on that whole thing and what that might mean for retail investors and traders, feel free to check out the recording. We also had a conversation about how to calculate forward yield as opposed to backward yield. We also had a conversation about reviewing JP Morgan as a dividend growth investing candidate. We reviewed Clorox and 3M from the same perspectives. We also talked about high-level strategy about how much should you allocate to a dividend philosophy if you're retired and you want to be somewhat a bit more aggressive. We had a conversation about a swing trade in Berry Oil. We had a conversation about selling puts in Chevron. We had a conversation about reviewing Pfizer as a long-term holding. We also had a conversation about ExxonMobil as a long-term holding, and then a conversation about some of the reorganizations taking place over at Emerson Electric. So if any of those stocks are of interest to you and you want to hear my conversation with my premium students about that, of course, just log into your account and go to the calendar for today and watch the recording. And you can see these are all timestamped, so that way you can kind of fast forward directly to the conversation that you want to hear. Also, while I'm over here on the internet, quick thank you to those of you that did click like for me the last time I did the market outlook related video here. Remember, you can click like on Twitter for these various market outlook related posts in 4 different ways. If you are watching this video on our website, while you're watching this, and by clicking play right here, you can just come down here and click like directly here, and it will recognize that. You can also go over to Twitter directly and look for the post pinned to the top of our timeline and click like there as well. We also have it listed in our description area of the YouTube video itself. So if you go directly to YouTube to watch these videos, go to the description area to click like on Twitter. And then lastly, that email that we send out to all of you that are on our email distribution list also has a direct link to Twitter to do that. We do all of that to make it nice and easy for those of you that want to take the 3 seconds to share your appreciation for David and I taking the 3 hours out of our day to do these videos. As I've told you many times in the past, when we are above 100, I have no issues with that and doing these videos on a daily basis. When we are below 100, I then start taking issue with that. So we think it's a perfectly fair trade-off, 3 seconds of your time for 3 hours of our time. If you want to vote in, let us know that you want us to continue to do these videos on a daily basis. I would encourage you to click like every single day to contribute to that endeavor. So anyway, hopefully we can get a little bit better with that at some point in the future. This would be a good time to let you know as well that I will not be doing the videos next week on Tuesday and Thursday like I typically do. I've got some other things I'd like to take care of. So thank you to those of you that have supported these videos in the past, and I'll be looking forward to joining you in these Market Outlook videos the following week. All right, back on track now with a bit more analysis on the charts. Let's go ahead and take a look here at another 12 grid. In this case, let's do some foreign stock market analysis. Let's take a look at chart 5E, which is the global stocks primary 12 grid. So as we pull this up, you can see that it looks quite a bit like what we've been experiencing in the United States. In other words, more selling than buying here recently. However, there is one notable exception, and it's probably the most controversial of these particular 12 markets right here, and that is China. China, of course, in the news nearly every single day, given some of the trade war worries and different things like that. Well, don't look now, but China had a nice enough bounce today, up 1.61%, where you're now above a rising 30-day moving average. Notice that that moving average color is green right there. Also, note that the background color of the chart is now light green. So that intermediate line is at 41 and rising. So remember, when it's between 20 and 50 and rising, we consider that weakly bullish. It's not strongly bullish. Nonetheless, it's at least starting down that potential path. You know, a lot of times in order to transition to a strongly bullish chart, you need to go through weakly bullish first. So does a weakly bullish chart guarantee that we'll eventually go strongly bullish? No, it does not, but it is at least a starting point. So of these charts that we're looking at here, all of a sudden this bounce move out of FXI is starting to raise a few eyebrows. I would also add that from just a traditional technical analysis perspective, you have an interesting place where it did decide to bounce. In other words, notice that over here on August 19th and then also again on August 20th, we kind of put in a bit of a, I guess you would call it a resistance area right there. Well, eventually we were able to blast up and through that zone, and then we gave back all of that price action right there. Well, guess what? We ended up bouncing exactly where you would have a horizontal line going directly to where we had that resistance area before. So there is a theory in technical analysis that old resistance becomes new support, and we are seeing that play out right now with China. We'll see where it takes us. We've certainly had head fakes in China along the way over the last 18 months, but here is another go around where perhaps some swing trades in some long Chinese stocks could very well be worthwhile investigating. Other areas of note that are on the opposite end of the coin, meaning strongly bearish in this case, we see France, Russia, and Germany are the three with the deeper shade of pink there, letting us know that those are areas that are still considered a bit more bearish and probably would be best to steer clear from if you're looking on the long side of the market. Let's now investigate some of the secondary global markets out there. This is 5G. Chart 5G for those of you that are following along at home that are premium members. And as you can see here, we've got a couple of dark green shaded charts on the board. We've got Turkey and we've got Taiwan. And so a couple of areas there that are gathering up a bit more strength than even what we see here in the United States. In fact, you'll notice that both Turkey and Taiwan within the last month or so hit multi-month highs, whereas we can't really make that claim in the United States. Notice that the S&P 500 is that chart in the upper left-hand corner there, and you'll notice that we're still grappling with this high that we put in back on July 26th. Well, in Turkey's case, the high was actually just here recently on September 27th, and the high in Taiwan was on September 13th. So we've had highs breached more recently in Turkey and Taiwan, and therefore, from a relative strength perspective, perhaps there's something to take a peek at there, as they both are trading above rising 30-day moving averages as well. In terms of the more lousy performance out there, you've got Indonesia, you've got Switzerland, but which, my oh my, I didn't even notice that myself, but Switzerland really fell apart here a couple of days ago. And then you have Saudi Arabia, which of course is floating the idea of gearing up for the Saudi Aramco IPO, which has kind of been talked about for many years at this point, but seems to be getting a little bit closer to reality. And then we've got Sweden as well, kind of matching that big drop there that we saw with Switzerland. So the two SW countries out there, Switzerland and Sweden, looking like they're not exactly the healthiest of markets on the planet right now. All right, so then that brings us to our trade application example for today. And for that, I wanted to bring up, let's first start with chart 1A, a trend trading chart, and wanted to pull up a stock in the real estate space. As I mentioned before, real estate has been reasonably strong. Remember that on Tuesday when I showed you the sector selector rankings, real estate was number 2 there, and I mentioned that real estate was the second best performer today, and real estate is also one of only 2 sectors along with utilities that are trading above a rising 30-day moving average at this current place. So real estate continues to be an area that exhibits some amount of strength out there. The stock that I wanted to talk about today was HCP. One thing that I've noticed is that a lot of healthcare REITs specifically, remember there's a lot of different types of REITs out there, but healthcare REITs specifically have been quite strong. HCP, as you can see here, over the last year has been trending nicely higher without ever truly breaching the 30-week moving average. This is a 1-year weekly candle chart that we're looking at here. This is the chart that I use in my Monday top-down trend trading class. So you can see that we've got this nice, gentle, gliding chart here where when you come down, you touch that 30-week moving average and you bounce off of it. You come down to that 30-week moving average, you bounce off of it. You come down there, you bounce away from it. And today we put in a new yearly high. Well, you'll also notice down below from these relative strength lines that it's clearly outperforming the Russell 1000, the real estate sector itself, and the equity real estate investment trust industry group. When you see all of those lines trending up and bunched up near the 100th percentile, it basically means that is a leadership stock within those particular areas. And it's not that that particular area has been hard or easy to beat, I should say. It hasn't been easy at all. It's probably difficult to beat that particular area because real estate has been one of the better areas for quite some time. So it's saying something when we have a stock like this that's beating an area that has been as strong as real estate generally has been. But just to prove my point regarding the healthcare REITs, take a look at Welltower in this case. WELL. Notice that it is on the verge of breaking to a new all-time high. We have Ventas, which I believe is it's VTR is the ticker symbol. Nice healthy bounce there today with that one as well. OHI, Omega Healthcare. It's within a stone's throw of hitting a new 52-week high. MPW is another one. That's also very close to a 52-week high. So the point that I'm trying to make is the idea of a rising tide lifting all boats. It's not just simply HCP that's going up. It's got one of the nicer looking charts, but it does seem like that whole category of stock is heading higher. So that's the 1 year weekly chart view. If I were to look now at a slightly different chart view, and by the way, you do have, of course, a bullish posture from a weekly candle perspective, as you could see there a moment ago. But let me go over here to the swing trading chart now and show you that particular view as I pull up ticker symbol HCP. And you can see that with this swing trading view that I use in my factor-based swing trading class on Wednesdays, we emphasize the near-term line on this particular chart. And from that chart's perspective, you also have a bullish posture. In other words, we have this blue shaded background here currently as opposed to the pink, telling us that we have a bullish posture from a near-term perspective. And as you can see, we were gently rising for most of the last several days when the stock market was really kind of struggling. And so when the stock market turned around and did well today, some of you might have thought, well, this one probably did poorly, right? After all, if it was doing well when the stock market was doing poorly, when the stock market does well, then it should do poorly. Nope, that's not what happened. This stock has just basically continued to go up day after day after day after day and now hit a new 52-week high. It didn't close at the high of the session, unfortunately, but nonetheless, even where we did close right here was above the candle that used to represent the old high. So that's a strong sign, the sign of a trending security. You can see that it's clearly outperforming the S&P 500, as you can see with these dashed gold lines down below here as well. So I find this one to be an interesting choice for a trend trading type of a setup right here. It might not be an ideal choice for a bounce trade since the bounce has already occurred, but from a trending perspective where you're willing to give it a little bit more wiggle room in terms of your stop loss, perhaps it is a place that is gathering some momentum right now. So then the question is, well, how much or how loose of a stop loss do you want to apply on a situation like this? Well, in this case, I would look for the most obvious pullback that we see on the chart, which in this case is right here to right here, and allow for that type of a pullback to occur again in the future without you getting stopped out. So in order to measure this from high to low, what I can do is come up here to my drawings, go to Drawing Tools, and then select this trend line, and then click at the top of this candle, and come down and click at the bottom of this candle. And as I was doing that, I noticed that that amount was about 7%. I can't show you very well that, but basically in this general area, look to the left of my pencil there. You can see where it says right now actually it's plus 2.88. But if I go down to the bottom here, it's going to say minus 6.89%. So in other words, it's about a 7% move from high to low is what investors had to absorb on this pullback, which looked pretty aggressive just by the old eyeball test there. And so if you were willing to absorb that type of a move again, this might be an interesting choice where you could apply a trailing stop mentality. Now we might go a little bit more. Let's do an 8% trailing stop mentality in this one. In other words, we'd be willing to absorb this type of a move, but we wouldn't be willing to absorb much more than that, and then we would head to the exit. So in order to do that, I'm simply going to right click on the chart. I'm going to come over here to Buy Custom with Stop, so that middle choice. That's going to load up our trade down below. I'm going to click that little paperclip icon. I'm just going to do the general default 100 shares. Obviously, you're going to want to position size according to your own rules. But what I'm going to do is I'm just going to, I'll leave this in there at 36.20 to get filled 1 cent higher than where it closed here today, hopefully first thing in the morning. But on the second line where it says stop and then day, I do want to change that day in the pink to good till cancel. And then where it says stop right here, that drop down, click on that and then choose trail stop instead. And then on this final line down below where you have kind of this darker plus and minus sign, click on that twice, 1, 2, until that looks like a percentage, and then fill that percentage out with whatever percentage you want your trailing stop to represent. As I mentioned before, we're going to do an 8% trail stop. So I'm just going to type in 8.00 and hit enter. It automatically applies the minus 8.00% in there on our behalf, which I can then click confirm and send. Review this one more time. Everything looks good. I'll send that in and we'll see if we can get filled first thing in the morning. All right, well, thank you for joining me here yet again. A great day for the stock market. We'll see what tomorrow brings with that jobs number. Of course, we still have a bearish overall intermediate posture on the markets, but if we can get a healthy bounce tomorrow, perhaps we'll start seeing that change in the coming days and weeks. So with that, I want to wish you all the best of success with your trades and your investments. If you did get value out of tonight's video, please go over to Twitter and click like. We know that less than a third of you that have Twitter accounts actually go out of your way to do that. But if you can do that for David and I, it'll send us a strong message. So thanks in advance for doing that as you typically have done in the past. So with that, best of success. Talk to y'all later. Bye-bye.